U.S. shale is what reacts most quickly, but already we see that the sector is under pressure because if we look where we were on total U.S. crude and condensate supply, in December we are at 13.5 million barrels per day. That fell to 13.15. In January, yes, we had winter storms and cold weather and so forth, but we only gained back 50,000 barrels per day of that in February. When you look at the Fed survey, the uncertainty for the E&P industry in the U.S. is enormous right now on the oil side. So when I look at our forecast at Svelland Capital for December production in the U.S., it's looking flat year on year. If you'd asked me last October, I was talking about 400,000 barrels per day year-on-year growth minimum. So the impact is definitely there. And that's already at these prices. And when we look at next year, that's where the bigger impact comes, because we could lose another 400,000 barrels per day and see an actual decline year-on-year.
You know, it's fascinating because, Nadia, the Federal Reserve of Dallas put out some data over the weekend that talked about where the break-even rates for a lot of those shale players actually are. I'm looking at a Permian Basin number as low as 61 on one part of that kind of area in the Midlands. Talk to us a little bit about the staying power of OPEC Plus here relative to that of U.S. shale. At these lower prices, how long can OPEC Plus keep pumping the market?
So the cost of production for OPEC is super low. And as we learned during the COVID volume war, Saudi Arabia will be the last man standing. They can keep pumping as much as they like. However, what they did in that situation, if they were to go for a full volume war, we'd expect it to last a month, 6 weeks, just enough to bring down the oil price massively and have curtailments happen across the globe. What we've seen that they've done now, adding 400,000 barrels per day for June, after adding 400,000 barrels per day for May, when I look at my balances for June, July, and August, I still see draws because we're going into the peak demand season for crude consumption because we need to refine products for summer driving. We need to refine products for cooling when it's very hot weather in Europe, very hot weather in the Middle East and in Asia. But the Middle East is the biggest driver there. So they could actually continue doing this again in July and even in August. So we get 1.2 million barrels per day additional crude. The problem is in October, and this is when you look at the shape of the oil curve right now. October is the first month that going into November, you see that contango, and that's because my balances show a build of more than 3 million barrels per day, and that is the problem with the strategy. Right now, they can just keep adding, but then are they willing to cut if we get a big oversupply, and especially if we get a demand impact from these tariff ongoing discussions?
Nadia, I'm putting you on the spot here. 20 seconds if you can. Give us a floor, give us a ceiling for Brent.
Right now, we see that the market has actually responded positively. We dropped down to 58.4 on the 9th of April. The market is max short, or it would be trading down right now. So we actually see upside from here. I think above $70 a barrel Brent, then we're going to start to see headwinds. Also, when we're in the lower 60s, we can get a demand response in the U.S. and in OECD Asia. That is positive.